Okay, we are all systems go for our final panel of LendIt 2014. So one of the things that investors, one of the ways, what investors want is to expand the universe of borrowers. We've heard that again and again. We want more borrowers. Where there's so much investor money, we want more borrowers. And one of the ways you can get more borrowers is to go down the credit spectrum. Now, obviously, we don't want to go down the credit spectrum and just massively increase the risk of our investments. So there's a new category we're calling emerging prime, and that is going to allow investors to maybe have access to some more high yield borrowers. But it's this is a relatively new area, and we're going to hear from several people who have a lot of experience in this today, and we're going to be led by Scott Riles, who is the managing partner of Echelon Capital Management. Over to you, Scott.
Well, thank you for staying. As Peter said, this is our last panel. You're either very interested or maybe your plane got canceled. But as Peter said, this emerging prime is the label, but what we're really talking about is as much as 75 to 80 million adults in the United States who are in one form or another outside or marginally in the credit system or are having trouble maintaining their credit worthiness. These four gentlemen to my left have all dedicated their professional career to addressing that opportunity. And I'll ask each of them just to go through down the line and tell a little bit about themselves and the name of their company, and then we'll talk more about how they're trying to attack this opportunity.
Great. Hi, everyone. James Gutierrez, CEO of InSeeked. I started my background in emerging prime, but we used to call it pre-prime, at a company called Progreso Financiero that was targeting the Hispanic unbanked population. At InSeeked, we're focused on a similar population of pre-prime, emerging prime, through partners where we provide unsecured small loans. And we also have an online securitization marketplace where we try and sell to investors who are looking to diversify into more easily investing in consumer loan assets.
Hello, everyone. A cocktail hour shortly awaits. My name is Joe Toms, and I'm president of Freedom Financial Asset Management. My background has been in asset management for most of my career. Last 3 years or 4 years, I spent time in both Lending Club and Prosper. We focus on what we do call emerging prime. We think it's actually an incredible investment opportunity over this next decade, and specifically we're looking for people who, from the crisis, have been knocked into lower credit scores, but we think have clearly improving fundamentals. We think there's a tremendous opportunity in this space because banks have clearly pulled back out of it, and it's a very, very large marketplace.
Hi, I'm Mike Armstrong. I'm the CMO of Zest Finance. By way of background, we are a mashup of former Google machine learning technologists and Capital One experienced people. I come from the Capital One side, where I helped build some of the credit card businesses there. Our IP is machine learning modeling, big data, and we feature that IP in two businesses. One is a B2C lending business, where we offer short-term installment loans to the subprime customer. And the other is a B2B business, not lending, where we license our machine learning technologies to other lenders and other industries, including marketing models, acquisitions, retention, upsell, cross-sell, as well as collections model, and subprime auto origination underwriting model.
And I'm Sasha Orloff. I'm the CEO and co-founder of a startup called LendUp. And what we focus on is helping borrowers that traditionally take out payday loans build their credit and learn good financial behavior. And we're a direct lending platform available with full algorithmic underwriting, instant decisioning, instant funding available on any smartphone, PC, connected device. Yeah.
So the category is broad, but each of you have a specific approach or focus for your companies. Maybe you could talk a little bit about who your target customer is, how you approach them, how you underwrite them.
Sure. So one great thing about the emerging prime population is that you have, I think, a little more pricing flexibility than you do in the super prime market. So in the super prime, there's a lot of opportunities. The banks are still largely in the market. In the non-prime market. I think with all the new regulations, the Credit Card Act, you have a lot of banks that pulled out. And so consumers really need access to credit, and you can kind of price for risk, I think, a little bit better. So we're targeting borrowers through partners where it's $200 up to $10,000 loans, unsecured, from mainly installment loans from sort of 3 months out to 36 months. The targeting is usually working through partners. So what we try and do is find partners who have good origination platforms where we can come in and try and provide some underwriting, some scoring, and being able to create a partnership where we basically fund the loans that they're making.
I think to start, I should probably begin with a little bit of a definition, because when people think non-prime, they obviously think subprime. And I think it's important to distinguish two different groups there. Clearly, there are customers in the near prime, subprime area that don't essentially have the income, the assets, the experience, et cetera, to really have large loans granted to them, et cetera. Some of these people here specialize in that, Sasha, for instance, in particular. We are focused on a different marketplace. We call it sort of initially post-prime. And what we're really looking for people who were prime at one time, who actually did accumulate quite a good deal of debt potentially, and then through circumstances that sometimes were unintentional, sometimes things just happen, got knocked into what we'd call that near prime, subprime category. Average loan balance is going to be between $10,000 and $15,000, so it's quite large. It's sort of equivalent to what you'd see on the P2P exchanges. And what we're looking for is the positively migrating factors that indicate to us that this individual has actually put into place the things necessary to improve their credit. As we all know, FICO is a backward-looking instrument. It doesn't really tell you a lot about the future of the consumer. And so we're very intent on using a hybrid underwriting approach. In fact, we do, which is credit modeling in addition to actual manual underwriting, where we discover the factors that are going to allow this person to improve their credit, and those are the people we're specifically targeting. As I mentioned, the average loan size between 10 and 15,000, 2 to 5 year terms, interest rates range from 10 to potentially as high as 36%.
So Joe's loans are massive compared to ours. We're targeting a very different customer, very similar to what Sasha, I think, is targeting. To characterize it in terms of FICO, it's the FICO 500 to 600 space. These are customers, ordinary hardworking Americans that, if their car breaks down and they need to get it repaired or get a new set of tires or need some money to fix the roof, they wouldn't have access to capital anywhere other than to go down to a payday loan store and take out a payday loan. And the problem with the payday loan is it's very expensive, and they are non-amortizing balloon payment loans where a customer can get trapped in a cycle of debt where they continue to make payments on the payday loans but never paid the loan down. So we've introduced a short-term installment loan. Consumers can borrow between $300 and $800. Our average ticket is about $600 between 3 and 8 months. And it's fully amortizing just like a normal bank loan. So as customers make payments, they pay down their loan. And compared to a typical online payday loan, we save our customers about 50% versus the other options they would have had in the marketplace. What allows us to drive this business model is our machine learning models. We deploy them across all the key functions of a lending business to include marketing. Our acquisition costs are a fraction of what our competitors pay for, and that actually buys us sort of positive credit selection, so improved credit for lower acquisition costs, which is exactly where you want to be in a lending business. Underwriting, so we have sophisticated underwriting models that are proprietary, built on this population for this product in the space. And our credit performance, again, is markedly superior to our sort of benchmarks in the industry, as well as collections. When you wrap it all up, the performance of our loans is such that we're profitable on the first loan, on a first loan basis with customers. We don't have to rely on churn with repeat loans in order to be profitable.
Great. Scott, what was the question again? What do you want to? Who's the customer and how do we underwrite? What's that?
Yeah, I think, yeah, exactly. That's the question.
All right, good. So our customers are consumers that typically banks and credit unions can't or won't approve. And they typically fall into one of three major categories. One of the first ones are people that just have no credit history. So you can think about a lot of young people starting off in jobs for the first time. They don't have an established credit history. It's hard to underwrite if you don't have data on the bureau. So by sort of default, most banks can't approve them because they don't have access to the data. The other sort of main customer segment are people that have thin credit. So they don't have a lot of history, not enough to really establish a true FICO score. And so it makes that also really difficult because there aren't a lot of information available. And then the third segment are sort of the people that have had damaged credit and trying to separate between those two. And so we do a couple different mechanisms to try and create a product that actually works with their needs and sort of fits with them. And we create sort of customized products for them. So our product is called the LendIt Ladder. And what it is it's a series of loans. And depending upon your risk level and depending upon your performance, whether you take our embedded education modules, whether you pay on time, whether you pay early, how often you check your balance, how much information you share with us, your loans, you have the ability to borrow more money at significantly lower rates. So it starts about a half of traditional payday, gets to about a 16th of payday, sub 36% FDIC, good looking long-term, well, I guess not comparative to some of the other banks, but long-term for us is about a year, $1,000. And so we do this through a variety of mechanisms, probably just slightly worse than what Zest does. But when you have very thin information, you can't use a traditional credit policy and a FICO score the way that I used to do at Citigroup when we were doing credit underwriting there for some of the credit cards. So think about sort of building models along various data sources from major credit bureaus to minor credit bureaus and public records data, cash flow data, bank records data, employment validation assets. And you have to use machine learning models because you need to be able to build a lot of features. And you can't have a model that collapses if some of the data isn't available. And for most of our customer segment, they don't have a lot of data available. So we use a mashing of traditional credit bureau data along with sort of smaller bureau data and other data sources. And we build a machine model with a lot of different features that give us a confidence level to be able to start somebody on their path up the LendIt ladder.
So recently, this market opportunity has caught the attention of certain regulators. Maybe you can talk about how you think about regulators and how you position your product in that environment.
So I didn't mention the APRs, but we're targeting, we think there's a great market opportunity, sort of 20 to, when you include interest rate and the origination fee in the calculation of an APR on an installment loan, between like 20 and 60% APR. And usually on a state-by-state basis, there are enough states where you can actually be in that range without having really any difficulty, let's say, with regulators. In California, in a prior life when I was the CEO of Progresso, we passed a law in California to increase rates on loans below 2,500, so that would fall directly into that program. I think what we've seen is if you want to start originating nationally and you want to be above some of those rate ranges for small loans, that's where you run into some challenges. And in particular, if you want to be in all 50 states and you're using a state charter model or a tribal model, I think some of those have been challenged depending on where you are. So what we found with the FDIC set this guidelines a long time ago for small dollar lending. It's not an actual law, it's just guidelines for their banks, but they seem to like the 36%. So we've tried to operate around that average and did that in a prior life and focused on doing that. But I do think in certain states there's room to go above that depending on what your licensing regime is.
In our case, because we're doing it in a slightly different market than what some of the other people are doing in, we are under the 36% cap. So from a regulatory standpoint, that isn't a concern. Obviously, there's always regulatory concerns in lending or whatever you do. But in our view, we think because we are actually providing money to people who are not getting a chance to access that money, and typically at lower interest rates than they can receive in other places, that's going to be perceived as positive from the regulatory authorities.
So some of the regulatory moves in our space have been pretty well reported on. We jumped into the space because it needed to be legitimized and needed to be cleaned up. I think we feel strongly that regulators begin with the customer's best interest in mind, and they are crafting policy to protect those interests. And it'll just take a while for some of the regulatory action to sort of settle itself out. We also feel strongly that these Americans in our credit, sort of spectrum, this credit spectrum, deserve access to credit. And we believe they deserve access to better forms of credit. So that's why we're in the marketplace to innovate, to drive price down. Out of the gate, we are 50% less expensive than the dominant payday loan model. We applaud sort of what Sasha is doing with his ladder product. We think it's fantastic.
Thanks.
We welcome the competition, and it's for the sake of the consumer. So we have lots of dialogues with regulators and with policymakers. We're always open to having conversations with them, and open to input from anybody who can sort of sit down with us on paper and help us figure out a better way to serve the customers.
There has been quite a good fair amount of attention placed on sort of the industry just below what a bank will approve. And sort of our sort of vision at LendUp is the word payday loan is a categorization that the regulatory sort of oversight created. So we're in it to use our technology to be able to underwrite and service customers that don't have access to traditional financial services like a bank. And that's our competitive advantage, is sort of our ability to model and create products on the fly. So we just fit into whatever regulatory scheme makes sense for the borrower, and whether it's currently, we're a state licensed short-term lender. We have multiple licenses, actually. We have state installment licenses. We have state short-term deferred to presentment licenses, which are traditionally payday licenses. But we just create products for people that don't have access to traditional banking products with a high degree of transparency. Credit building is really important. We have embedded education. And the pricing scheme and how many people we can reach is just a function of how willing a bank is, or local banks or credit unions, to lend into their communities versus the alternatives. So we just follow the laws, and we actually create customized products in every state that we operate based upon the regulatory infrastructure that the states dictate. And we just create the best solution we can that fits within this, that makes sure that there's always embedded education, the price is always compliant, and that we create a path for borrowers to actually be able to build and report to the major credit bureaus so they can build their FICO score. Because whether we agree or not with FICO score as the right metric, it's used today by banks and insurance companies, landlords and employers. So we want to help people be able to get to a better place, and getting to a stable financial place and have the ability to report to the major bureaus is just an important tenet. So we fit within whatever regulatory structure the state and federal law dictates.
Just one last thing. This debate is not only about rate. I think the CFPB and some of the other organizations have also focused a lot on the stability of your underwriting. So in other words, are you actually checking someone's income, verifying their income, that they can afford the loan that they're getting? And I think there's a lot of, there's going to be some new guidelines around the affordability tests that you incorporate into your underwriting. And I think actually, if you're doing those things and you're sort of checking the box, and like INSEAD, and as Sasha said, if you're reporting to the bureaus, helping somebody build credit, that's another check. So it's not entirely about rate. And I think also people in DC realize that the FDIC small dollar loan program failed. Yeah, all those banks pulled out, weren't able to make that product competitive. So I think the debate is still out there. There's no hard line in the sand that was written into Dodd-Frank or any other law about an interest rate cap at a federal level. So I think folks are still trying to figure out, where do you fall? I think we realized below 36 is very hard to make work, and certainly some, certain people don't like triple-digit rates. So, the debate now is kind of going more to income affordability tests, sustainable underwriting, those sort of things.
One of, I think, the key assets to everybody here on stage, we saw a market where there really wasn't any underwriting actually going on. And one of the key components of any type of lending business is you gotta underwrite. And you can't necessarily just underwrite on the ability to grab money from somebody before they have access to spend it themselves. And so I think that's one of the sort of most interesting things that are coming out. And I think regulators are just now starting to understand and get that, which is my guess to all of our competitive advantages in the long run. We just have to figure out where where the ink hits the paper and how that comes out.
This is a peer-to-peer conference, so how do you think about a marketplace structure versus keeping those loans as a principal on your balance sheet?
So I felt the pain of this before. So my last company, so Progresso, we made about 500,000 loans when I was there. We had a several $100 million portfolio. We were borrowing money from some great people also probably in this room, like some hedge funds and others. But over time, if we were growing so quickly, the liquidity risk in the business is so massive. You know, if you can't fund those loans, you know, $25, $30 million a month of loans, then, you know, your whole business can fall overnight because your product's money. And so what we've done with Inseeked is we've said, you know, there's a smarter way to do this. We should build a marketplace because right now there's so many yield-starved investors who really want yield. They're segmented. Some want low risk, lower yield. Some want take more risk, you know. And so what we're doing is creating this marketplace that kind of democratizes the access to high quality securitization that you can trust and it's transparent. And so we've created an online, you know, site where you can go in, get all the loan level data, you get access, and everything that we originate, we then put out to a broader group of investors, not just the same 20 insurance companies, but family offices, accredited investors. The idea being that you basically reduce the liquidity risk because it's more of a marketplace approach. So having been total balance sheet lender before as a non-bank when you didn't have deposits and seeing how the ups and downs can totally kill your business even if your underwriting's good. I think we've chosen for Inseeked to build more of a marketplace approach, and I think, you know, we're excited about the prospects of doing that and also allowing investors to build great fixed income portfolios, you know, through Inseeked.
So we've taken a different approach. I think the marketplace approach obviously is very successful. It's done very well. We're taking a more fully integrated approach in the sense that what we want to do is, I think there's sort of three key components you have to be successful. You have to have a good customer acquisition strategy. You have to be able to do that obviously at an economic cost. You have to have a very robust underwriting process, which includes doing, in our case, in the area we're dealing with, not just credit modeling, but actual manual underwriting. Servicing collections is obviously part of that too. And then there's the investment delivery. And our view is that a streamlined approach, just like a bank would do, will be more effective at getting customers at the right cost, at underwriting them correctly, and then delivering the returns to the investors. Now, what we're different on is we're not doing it on balance sheet. We're not a marketplace, but what we're doing for large institutional investors is saying we will be, in essence, your bank. We will go do all of this from A through Z, and what you will receive at the end is the yield on the portfolio. So we've definitely taken a bit of a different approach there.
So we're on balance sheet. We've been fortunate to have some pretty great debt funding partners. You know, that said, you know, we're paying some pretty steep coupons, and you know, of course, we'd be open to exploring you know, cheaper, more diversified source of funds. The peer-to-peer is very interesting to us. We understand we're sort of well south of sort of where the sort of current market is in terms of the sort of credit ranges. But that said, the credit performance that we have and the track record we built up over the last 2.5 years is such that we think it's just a matter of time, potentially, until we find the right sort of set of folks who would be willing to sort of entertain you know, some dialogues with us and with other players in our space based upon the credit performance and the kind of returns that those investors, kind of safe returns that those investors could yield.
So I think about it along sort of two axes. The one is kind of what James was talking about in terms of just liquidity risk of a business and having diversified source of capital should something happen in one place or another. As successful businesses grow, we obviously as lenders require capital. So at the beginning, we had a couple different sources, a couple private family offices that were funding, and we were tracking them according to the different funding sources. And we started growing really quickly, and Victory Park, who is potentially somewhere in the crowd, realized that as a startup and you need to focus and grow, came in and consolidated all of our debt and provided us with a good amount of runway for the time. So it allows us now just to focus purely on growth. As we grow, I think there'll be interesting mechanisms that come out of hopefully OnDeck and Lending Club's potential IPOs that will give a good sense about what multiples look like for platform businesses versus direct lending businesses. That'll be another factor, but the mainstay will just be providing slicing and dicing different aspects of our business according to the risk profile and the returns that the different investors want. Naturally, as our product sort of grows, even if we continue to grow at 10 to 20% of new customer originations every month, given our model, as people come back, that returning customer becomes slightly higher. And since we're deploying more capital per customer over time, the capital actually grows exponentially. And with that comes a nice suite of very diverse tranches. We call it silver, gold, platinum, and prime. But you can think about in the long run how that can fit into different investors that want something much more stable and long term at a sub 36% rate versus sort of different risk appetites. So I think we'll get creative, and we'll also see sort of how the next 12 to 18 months pans out and go from there. But the only thing that I can say for certain is we're going to need a ton of capital because we're growing like crazy, and that's a good thing to have, I guess. We'll figure it out.
We've just got a couple of minutes left. I'll turn this open to the audience to see if they have questions. It's the last panel. Do you see somebody?
I see a hand. I see a hand.
Right here. Go ahead, sorry. Go ahead. He's coming.
Thank you so much. Can you talk a little bit about consumer acquisition, like which channels, how do you approach, how do you think about them, long-term SEO, Facebook, all these channels, and where are you guys going after, and where do you guys see good results?
I'll start off. So I think we're trying to take a slightly different approach. We spend a lot of time making sure that our product is very differentiated from our competitive set. So we're on the sort of beginnings of trying to change the conversation from don't do a payday loan, don't use a payday loan, to don't use a payday loan, but use LendUp, right? Before you had to say, just don't do this. Now there's a market alternative that helps you build credit, teaches you about good financial behavior, rewards you for this automatically, is cheaper, gets cheaper over time. So part of the aspect is that unlocks different types of partnerships, whether it be other providers where there are subprime borrowers, but they've never been able to offer anything to that 85% that banks decline, or websites where people are going to find sources of capital. And a lot of sort of community groups that work deep in the communities have sort of not had that other alternative. Something else that we see as an advantage was a little bit alluded to what Nick was talking about on the venture capital team, which is having a brand. And while you can't sort of buy your way into a brand necessarily, and you can't force a brand to happen, one of the things that happens is having kind of a clean, very customer-friendly solution is that we can get press and PR, and all of that sort of helps create something where there is one single name that is an alternative to payday loans that happens to also help a lot with SEO, whereas our competitors will potentially create a lot of different subsidiaries, and as the government shuts down one, they open up another one, they shut down that one, they open up another one. You can have a single unified brand that by the time a customer hears the name LendUp a 7th time, an 8th time, they're now sort of building that trust and that relationship. So we find those really great. As we continue to expand across the country and become more of a national player, that will unlock some of the traditional stuff that have probably built a lot of your guys' businesses, but we haven't quite got there yet.
So just one thing on that. So in prior life, we had 100 stores. Big cost of acquisition, lots of people. One thing we're doing here is we're working with partners where we're really good at using thousands of attributes, alternative data. We did this in a prior life, and lots of Cap One experience and other at our team, that if we can find someone who might focus on prime and all the people that they pass that are not, that are more in our sweet spot, let's call them pre-prime, we can get really good at decisioning those and basically originating through that sort of partnership. And so we're exploring a lot of those.
And I think in this space in particular, what you find with more stressed out consumers is that they do tend to use online channels more often than not, and there's no big surprise. They want to go to a bank and say, hey, I'm going to get turned down. There's the personal interaction, the whole process of that. It's a difficult thing. So we use online and offline, but we also use, again, a process in a hybrid sense where we do actually talk to the consumers, because we think it's incredibly important. There's discovery that goes on, depending on what channel you're talking about, through that actual personal interaction. We think it creates a much better understanding of the channel, its value in terms of the credit quality, and whether we can actually help the consumers in that space.
Any other questions? Well, I'd like to thank our panelists, and I thank the audience for staying.
Have a back.
Try to throw in a little shout for you.